Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 42. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, two topics today: 5 lessons from Howard Marks, and 2 Signal or Noise. We got valuations we're going to talk about, and the meme coin mania has really accelerated since we last spoke, and we're going to discuss what that means for investors. Okay, 5 lessons from Howard Marks. First, Howard Marks probably needs no introduction, but founder of Oaktree Capital, over 200 billion in assets under management. Most of that is distressed in credit assets. And Howard Marks really became famous for his memos that he writes. Peter, I'm sure you've read many of those over the years, but interesting fact that I heard years ago listening to him with Barry Ritholtz on Masters in Business was he started writing these memos in 1990, and for 10 years, Peter, for 10 years, he didn't get a response from anyone. He used to mail these out, put them in envelopes, and send them out to clients.
Oh, I
And
had
he
not
kept
heard that.
doing it for 10 years. Isn't that incredible? And
That's
did not give
insane.
up.
Yeah, that's incredible.
Kind of amazing, right? In today's world where everyone wants that instant reaction on social media. And there was just something within him that he said, this is helping me, even if no one seems to be responding to it or getting anything out. I'm going to keep doing it. And then finally, in 2000, he wrote this memo called bubble.com right before the peak in the .com bubble. And that got a lot of attention. And from there, the rest, as they say, is history. So good lesson for investors. That's not in here, but just good lesson for people that the overnight success concept, it tends to take a lot longer than you think. And when you see someone who's famous out there, you didn't see what went into it before that. So 10 years he wrote without a single response. Okay, here we go. 5 lessons from Howard Marks. Lesson number 1, live to fight another day. Here's a quote, Peter. There are old investors and there are bold investors, but there are no old, bold investors. Hard to say that quickly here, but I just want to run through some stats of late that I think apply to this. Really, there's been a proliferation in terms of options trading. You can see here the average daily volumes annually and just that huge spike that we've seen over the past few years, record highs. And historically, a lot of this was used by professional firms. They would use it for hedging purposes. But in recent years, this has really expanded more to the retail crowd. And what's been especially popular is this thing known as 0 days to expiration options. You could see the share of S&P 500 index options expiring the same day over 50% now. So a huge proportion of this options trading is really that binary situation where you're either right or wrong on a particular day. And a lot of retail investors are jumping aboard this. And it's hard to call it anything other than gambling, Peter, when you're really speculating on a single day, where the S&P 500 is going to close on for that particular day. And what we're seeing here is either they're making incredible gains, or probably more often they're losing a lot within minutes or seconds. So I know you probably advise people all the time saying, stay away from this type of stuff. But is it becoming harder in this day and age, this kind of gambling mentality? You watch sports games and it seems like every third or fourth commercial is encouraging people to bet on something, and it's kind of transferred over into the financial markets as well.
Oh, there's no question. I think people also there's this thing called FOMO, right? Fear of missing out. And nowhere do I think is it more intense than the financial markets. If you look back at SPACs, these vehicles where people would put kind of garbage companies, not all the time, but most of the time in them, dump them on the public, have celebrities promote them, they really took off. And I remember writing a letter like, hey, this is crazy. But that letter against the wall of chaos, all of this opportunity that everybody sees, and my neighbor is getting rich. Of course, we know how it ended. It collapsed. We saw the same thing with NFTs. Wrote a letter about that. Most of this is gambling. Separate the technology from buying a picture of an ape. This doesn't make any sense. Don't pay $100,000 for a rock. But when you see people making money so easily, just last weekend, Trump released a meme coin. I think it was the day before the inauguration. And my son's friends were all talking about it, and it went up thousands of percent, and within hours. And how can you not feel like you're missing out, right? Like, how stupid am I to sit on the sidelines while, somebody makes, 1,000%. At one point, the meme coin had a better return than if you own the S&P 500 for the last 60 years or own gold for the last 60 years. It's hard to be on the sideline when it looks like the easy money's there, and the media really isn't there. All the attention isn't really there when the meme coin drops 50% in a few hours the next day, or when NFTs drop 99%, or when the average SPAC drops 50 to 70%. You just don't have the same attention on the backside. We're usually on to the new crazy thing, whether it's something like GameStop or something else. We just move on to the next craze where everyone feels silly being on the sidelines.
Yeah, and now we just have more ways to do it. So we talked about options, but there's just a lot of new funds, leveraged funds that are coming out. Seems like every single day. And this is a crazy stat that I saw from the Wall Street Journal. The size of these leveraged ETF funds in the US grew 46% last year to about $137 billion, and 20 billion of that, Peter, were in single stock funds. So you're leveraging just the name of a single stock. And I think the craziest one that I've seen that's talking about levering a single stock has to be MicroStrategy, which by itself, as we know, is very volatile. It's really just become a proxy for Bitcoin, many calling it a leveraged bet on Bitcoin itself, but that wasn't enough. And they had to come out with this product that tries to track double the return of MicroStrategy in a given trading day. And there are people investing in this, not just trading it, but investing it thinking that it's a good long term strategy. What they mention here in terms of the risk on the downside is that a 51% one day decline in the stock price could wipe out the funds altogether. So I went back and looked, has that ever happened with MicroStrategy? And indeed, it actually did back in 2000. Right around the dot-com bubble peak, it actually went down 62% in a single trading day. So these leverage ETFs and on single stock leverage ETFs, obviously the temptation is for people to say, I can make a lot of money very quickly. But going back to that, no old, bold investors, the risk reward here is very troubling because the downside could be losing everything.
Yeah, I mean, I think people underestimate. And I think there's also a false sense of security when you enter an intermediary fund. Like, it's one thing to invest in MicroStrategy, you understand your risks, but when you invest with an institution that is then investing in MicroStrategy, whether it's with leverage or anything else, there's this I think this feeling of safety that doesn't exist, and in fact, it's much less safe because of the leverage in this case. But I, whenever you're giving your money to somebody else, you can create this idea. Well, I mean, it's legitimized now. We see that with cryptocurrencies, right? There a lot of places came out with top 10 cryptocurrency baskets. And of course, those wound up being a disaster because only one or two cryptocurrencies wound up going up in those baskets, and the vast majority of them completely collapsed. But there was a legitimacy that came around that wrapper that gave people comfort when they should have had quite the opposite feeling.
Yeah, and to your point there, in terms of outsourcing this, what they were talking about is MicroStrategy last few months. Many times it wasn't able to track that 2x because the swap providers backed away from it, so they had to revert to using options and other things. So clearly, they're having difficulty at this point, and really, unfortunately, there's going to be a day where there's likely going to be a big one-day decline, and investors will have to learn the hard way. So just make sure you know what you own, why you own it. These leverage ETFs, yes, you can make a lot in a short period of time, but you could also lose everything. Okay, let's go to lesson number 2. High prices don't tell you what happens next. And here's the quote here: prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a long time, or become far more so. And I think, Peter, the best example of this would have to be during the 1990s. I'm showing you the CAPE ratio going back in time. And in July 1997, we hit a level on the CAPE ratio that we had never seen before, which simply means that valuations were higher than ever before. It passed the prior peak that we saw in the 1929 right before the big crash and the Great Depression. And a lot of people at the time in 1997 were saying things were stretched, and they were stretched. But as you can see here, it didn't stop there. Valuations continued to expand for a few more years. And I want to show you what living through that period of time, if you said at that point in time, I'm going to get out of the market, valuations were high, seemed pretty prudent. And this is what actually happened after that until the peak in March 2000. The NASDAQ 100 goes on to go up 324% after that
Right.
point in time, and the S&P 500 up 60%.
I mean, you can look at an investment and someone can make a perfect case that this index or this market or this stock is overpriced, and they could be 100% right. I think the disconnect is, as you stated earlier, that does not mean that the price has to come down. The price can hold steady while earnings grow, and then the stock price can begin to move. Or the stock might deliver on an unexpected upside surprise where they have a whole new path to even greater earnings, and not only stay steady, the stock price can increase. Earnings and stock prices match up over the long run, but in the short run, they don't match up. And I think this is the problem with this is undervalued or that is undervalued. Markets can stay far off their historical norms, they, far longer than you can tolerate it, right? And so making judgments based on something being overvalued or undervalued is a mistake. The stock market's at an all-time high, one in 19 days. We know right now the US market is considered overvalued by almost every metric. It has been for years, hasn't mattered. It's continued to outperform all other markets. Part of it has been multiple expansion, but part of it actually has been an increase in earnings, and part of it has been this shocking AI revolution, the speed and velocity with which it's coming, and how it's all happening in large US stocks. So it's a great example of something was legitimately overvalued a few years ago, but has still been the best performing major asset class for multiple reasons.
Yeah, so a lot of lessons here. Valuation, not a timing indicator, definitely doesn't tell you what's going to happen next, even if it eventually does matter. And it often does. You can't predict when it's going to matter. And this applies to individual stocks as well. I just picked out here the best performing stock in the S&P 500 last year, Palantir, obviously benefiting from a number of the trends that you were just talking about, but up 340%. And coming into the year, Peter, it's trading at 190 times earnings at 18 times sales. And it ends the year at 378 times earnings and 69 times sales. So, not to say that those valuations aren't extreme and eventually they might cause problems for investors, but the notion that you could short a stock just because its valuation is high and that it's going to crash tomorrow because its valuation is high simply isn't the case. Investors can remain irrational far longer than you can remain solvent, is the famous quote on that. Okay, let's go to lesson number 3 here. There's no such thing as a sure bet. I love this story from his book, The Most Important Thing. I tell my father's story of the gambler who lost regularly. One day, he heard about a race with only one horse in it, so he bet the rent money. Halfway around the track, the horse jumped over the fence and ran away.
This is my favorite quote because it's so unexpected, but it speaks to what's happening, what happens with investing. And to your point, no such thing as a sure bet ever in the markets. Everything can line up perfectly. Never have all your eggs in one basket or all your money on one horse. This is my favorite Mark's quote.
Yeah, and it just shows you in markets how applicable it is because we have these black swan events happening all the time. And just when you think you have everything figured out, the next one comes along. And whenever I hear people saying, well, this stock, it's a blue chip, it can't go down, it can't underperform. Well, every year we have examples of that going the other way. And I just picked out two here, Disney and Nike, which for years were just staples in people's portfolios, and you would think these brands just always outperform, always will go up forever. And I'm just showing you the last 5 years here. S&P 500 up 96%, Disney down 24%, Nike down 26%.
Yeah. And today people use that language around Nvidia, Apple. It's been going on a long time, and eventually, every stock has its day. That's every stock has its day, good or bad.
Yep. And the risk is there even if you can't see it, just like that horse betting example.
Yeah.
It's out there even if you can't see it. There was a risk in Disney and Nike that investors obviously didn't foresee. And every year there's companies that go bankrupt. And if you look at their charts a few years before they went bankrupt, most of the time there was no indication or warning that that was going to happen. Okay, let's go to lesson number 4 here. Change is inevitable. And this is from his most recent memo, Peter, called On Bubble Watch. And he wrote, in bubbles, investors treat the leading companies and pay for their stocks as though the firms are sure to remain leaders for decades. Some do and some don't, but change seems to be more the rule than persistence. And I want to show you here the chart of largest US companies by market cap going back to 1960, going decade by decade. And the one thing that seems to be constant is that there's a lot of change from decade to decade. Obviously, we're only halfway through the decade here. And what's been interesting so far is there hasn't been a lot of change at the top, and people are assuming that's going to continue. Historically, that's been not a great bet to make.
I mean, the advantage of owning the S&P 500 isn't so much that the number one stock will drop out of the top 10. It's that the future number one stock is not in the top 10. So Nvidia wasn't there 10 years ago, 15 years ago, but it literally is responsible for the biggest lift in the S&P 500 because of its market cap and its percentage gain. And I think that you to catch that needle in the haystack, you got to own the haystack. And so if you had all your eggs in the top 10 basket, you're going to underperform the person who's catching Apple before it cracks the top 10, who's catching Tesla before it cracks the top 10, and who's catching Nvidia. There will be other stocks in the next decade that show up out of the blue in the top 10. And to get there, they had to go up several thousand% probably to get that market cap where it needs to be to get there. And you get that percentage rate of return only if you're diversified.
Absolutely. And if we look here, interesting, in 2024 and compare to 2000, what you'll notice here, only one stock from back then still in the top 10, and that would be Microsoft. But what he's talking about here, Peter, in terms of what people are paying for these stocks as if they're going to remain leaders forever, that is the big question. And we talked about it last week for investors: is are investors paying too much for these magnificent 7 stocks? I'm showing you here the valuation multiples, price to earnings and price to sales. And while some of them don't seem to be that extreme, if we look at Google, but if we look at the other end of the spectrum, Nvidia, certainly Tesla, and we look at multiple of earnings, multiple of sales across the board, higher, much higher than where they were 10 years ago.
Yeah, I think that it's just they come out of the blue. I mean, no one was talking about Nvidia 10 years ago. Certainly not. No one expected what was going to happen. And you were looking at Palantir earlier. I mean, there's always something just coming out of nowhere and crashing the party.
Yeah, the question will be 53 times earnings, Nvidia 29 times sales. The question will be, of course, can it continue to outpace the expectations in terms of growth? And the incredible thing the last 2 years is it has, right? We
And
have
today,
yet to
while
see.
we're recording this, it's up 5% today. It's
Yeah,
just it speaks to how hard it is to have discipline and not throw your eggs all in that basket when it day after day after day, quarter after quarter, and even for years, you watch the market, this stock defy gravity, right?
yeah, sometimes there's an outlier that actually grows into that valuation, and Nvidia has been that example. So far, we don't know how it will end, right? We don't know ultimately will that continue, will competitors come in, will things go wrong, will there be a downturn in the economy, and so on and so forth. But for now, it's coming back to that idea that valuations aren't predictive of the short term
Right.
whatsoever. Okay, let's go to lesson number 5 here. We learn the most from tough times. And here's the quote here: experience is what you got when you didn't get what you wanted. Good times teach only bad lessons, that investing is easy, that you know its secrets, that you needn't worry about risk. The most valuable lessons are learned during the tough times. And speaking of good times here, Peter, we have now the second longest uptrend for the NASDAQ 100 in history. So we're going on 466 trading days above its 200-day moving average. It's only been exceeded one other time. The index is up around 90% during this incredible run. And in terms of lessons, are investors learning more of a lesson today or during this run, or did they learn really the most difficult lesson when they went 15 years for the NASDAQ 100 without hitting a new high and there was an 83% drawdown along the way?
Yeah, and I think the issue is that's so long ago, people have forgotten any lessons they may have learned. We have a lot of recency bias. We've gone a long time without a real bear market. And what's interesting is the last one was COVID. And I kind of put that in a different category because people were so worried about their health, their physical health, their mental health. They really didn't have time to get too caught up in this. And it was so short lived. It was average bear market in terms of percent, it was down 34%. But in terms of speed, it happened so fast. It was the fastest 34% drop. I remember recording a video for our clients like, hey, I suspect the government's going to intervene and we should be buying into this weakness. And the next day, the government intervened and the market, was on a path to recovery very, very quickly within weeks. And of course, the market soared with all the inflationary policy since then. So I don't even count that as a bear market because no one was
Yeah.
focused on it and didn't have enough to. We've gone a long, long time, and bear markets that go on normal, months instead of weeks, tend to teach more lessons. And it's we've got a whole generation that hasn't had that lesson yet.
Yeah, but we know it's coming. The lesson. It's so the reason you're getting these enormous returns is because of that risk. It's just a matter of time before investors learn that lesson. And what we've seen during this ridiculous run here, it happens, right? These
Yeah,
long trends seem to happen more frequently than people assume is possible. No one knows when the trend is going to end, but all we can say is this is an outlier period for investors. Don't expect this to be the norm, let's
right.
say, over the next 10 years. So, with that, that's the 5 lessons from Howard Marks. Maybe we'll do another 5, Peter, because I just had so many other examples. So maybe we'll do another 5 at some point. If you're watching this today and you're thinking about how to invest for 2025, reach out to us today at Creative Planning. Set up a call or meeting with an advisor. Go to creativeplanning.com/Charlie and get your free wealth path analysis. We're in all 50 states at Creative Planning, over 325 billion in assets under management and advisement, and we're here to help. So reach out today, creativeplanning.com/Charlie. Okay, Peter, let's go to signal or noise. We have 2 interesting topics here. First, I want to get your take on this chart here. I'm showing you CAPE ratio, so the Shiller PE ratio, at the start of every presidency in the last 100 years. And you could see at the top here is the current Trump term, and 37.8, higher than any other CAPE ratio at the start of presidency. Uh, George W. Bush was number 2 with a CAPE ratio of 37 back in 2001. And that was the last president to have a negative return for the stock market. What do you make of valuations here? And we've talked about it many times, but is this something that's going to make it more difficult for the stock market to have strong gains over the next 4 years?
I mean, this is priced to perfection, and I think we could get perfection. And I think the reason we could get it is you have things that are favorable to business. So forget about the political side of it. We are definitely have an administration that is going to diminish regulations, and every business has regulations. And whether you're in the airline business or the meat packing business or whatever. And every time there's more regulations, you need more people internally to handle those. Well, less regulations, you need less money spent on that. That drops to profits. Corporate taxes, talk about bringing them down. If you lower corporate taxes 1%, the profits go up 1%. It's just kind of that straightforward. And obviously, just the bias of pro business, it gives people confidence to invest more in business. You also have a very aggressive energy policy, which should lower oil prices. Oil finds itself in the cost of everything. You buy a meal at McDonald's, it got there on a truck probably, and had to get there somehow with oil, right? And so you've got that's a very big component of expense for businesses. There's so many things this administration has that are pro business, but they're coming in with a very, very, very high stock market because of so much money saturated in the system, plus an AI revolution, plus earnings growth and low unemployment. So you have all these different positive things that drove the ratio up, but you also have a bias coming in where it's possible that everything goes perfectly and there's not a price to pay for this. But these are very rich valuations.
Yeah, and it just comes back to probabilities, right? We don't know where that CAPE ratio is going to be 4 years from now. That's the big unknown. And many people, when Biden took office, said valuations are pretty high, right? And they were. They're 34 and a half CAPE ratio. But what they did not anticipate is valuations went even higher, and you had very strong earnings growth, as we know, over the last 4 years. So could this be 40 a few years from now? Of course it could. No, there's no question. What we know historically, though, Peter, is there is a relationship. It's just not in a 1 year period. You have to go out long term, over a 10-year period to see any type of real relationship here. And what I'm showing you is the starting CAPE ratio and forward 10-year returns on the S&P 500. What you can see is there's definitely a correlation here where the highest valuations tend to have the lowest future returns. If we're looking at the highest decile of CAPE ratios historically, they've averaged about 3% annualized return for the S&P 500 over the next 10 years. And we look at the cheapest valuations, and we've seen 15% annualized returns. Now, again, though, you have to go back to, well, what will valuations do in the next 4 years? And we can't predict that. And even if we look 10 years ago, Peter, what's interesting is we were about 27 in terms of the CAPE ratio back at the end of 2014, and stocks did very well over that next decade. So people were making a similar argument, and valuations only got richer over that decade. And it's impossible to say where valuations are going to be 4 years from now.
Yeah, it's just what we talked about at the beginning. It's things return to their norms, but not on the timeline that we expect them to. It takes much, much longer to get there.
Yeah, to me, this is just an additional argument to stay diversified, have things in your portfolio outside just the largest stocks in the market. We know that's what's been leading, but in the chance that it won't continue to lead, you're going to be happy that you have other areas of the market in your portfolio that aren't as stretched on a valuation basis. Okay, let's go to number two here. I didn't think I'd be following up Fart Coin with something else here, Peter. But
Right.
very quickly, I think I want to say this was unexpected, right? As the day before, as you mentioned, the day before the inauguration, we get this post from Trump. At first, I thought maybe his account was hacked, but it turns out it was not. And he announces that they're launching this meme coin, the official Trump coin, and very quickly the price goes up. I think it's only about 20% of the available supply that they released into the market. So at its peak, this is just showing you the available supply. At its peak, it was around 15 billion. So which means that the total diluted market value was about 75 billion at its peak. And that's just mind boggling in so many ways. And I'm just going to show your post reaction to it. You watching the meme coin past 30 billion in market cap. Um, Safe to say, Peter, we've never seen anything like this before.
No, absolutely incredible that the day before an inauguration, you basically have the release of something that isn't intrinsically worth zero. Almost everybody knows is going to go to zero in a matter of time, and you see this huge run up. And I think I'm I'm sure there's a lot of people that put money in here that was meaningful to them that were really just transferring their wealth to others. And eventually, this is a zero sum game, and there are going to be a lot of people that lose a ton of money in a very short period of time here. I'm just I I can't believe it. I shouldn't say I can't believe it. I believe anything that happens now, but
I can't believe
it's
someone
disappointing.
advised I can't believe someone advised him and he took their advice to actually do this. In
Yeah,
so many ways, it's just a bad look,
it is.
right?
Yeah,
To
it's a
say that
terrible look.
he
And
could be
it really,
influencing the price of this coin and profiting off it. And yeah, maybe it retains its value. Who knows? Dogecoin, I would have thought would have been zero at this point, and it's not. So, right, it's
right.
at a certain point, it's just a popularity contest, and people are saying these are just the new pieces of art, and their value is just simply because someone wants to buy it and say they own it, and there's nothing more to it than that.
It's ridiculous. Yeah.
Now,
Unfortunate.
yeah, it seems absolutely insane, and the likely outcome will not be good for people. But my question really is that is this an indication of some broader sentiment, like speculative animal spirits? Just this doesn't occur, this type of behavior doesn't occur in a vacuum. Like, let's say the stock market and crypto and everything wasn't it didn't have the year that it did last year. Would you see this type of thing? I'm guessing no, and it really reminds me of that early period of 2021 where you could come out with a SPAC every single day, where you had just this enormous speculative activity in meme stocks, and now it's just gone one step further in terms of just creating these things out of thin air. And just another way, coming back to that first thing we were talking about, another way for people to gamble and either make a lot or lose a lot in a short period of time. So do you think this is a indication of broader sentiment, is kind of saying there's no risk here, so why not just gamble on the riskiest thing I can find?
Yeah, I think the next bear market that's real is going to wash out a lot of this. That's what we see cycle after cycle, whether it's the dot com or the washout of the NFTs and everything. We'll see eventually money come out of the system coupled with a bear market, and it will really kill a lot of these purely speculative things. And then we'll wait until the recovery for whatever is new to come back and replace them.
Yeah, that makes sense. We just can't say when it's going to happen.
That's right.
But if we look back a year or two from now and we see this stuff crashing, I don't think I don't think it should come as a surprise to anyone. All of the signs were there, clear as day, to say this is some kind of mania. And in a mania, you can't predict how long it's going to go on and how high it's going to go. That's the nature of manias. You just know in the end that the weighing machine will come in. And what I always say with this stuff is if you start, yeah, when it's going up and the greater fool is working, it works great. But if someone has made some kind of profit in this thing and starts going down, how likely are they to hold on to this thing just on a meme? I don't. No one's arguing that there's a use case here, Peter, right? Whatsoever. They're just saying this is fun and this is games and this is
Right.
the
Right.
new way of the future. Is it doesn't have to have an intrinsic value.
It's a new baseball card collecting is kind of the theory, right?
I I guess so, and so we shall see. But as I'm saying here today in January 2025, all the signs of a speculative mania
Yes,
as a in these meme coins were there. Okay, with
concur.
that, Peter, let's end it right there. If you're watching this on YouTube, hit that subscribe button. Thanks everyone for joining us, and we'll see you next time on Signal or Noise.